Awesome. Thank you, man. So far, you've given like a lot of good information. So, thank you for explaining it and breaking it down so well. I'm just going to talk about the financing part just for a little bit because if you're going to buy the home, you need the money to buy the home. All right. And one thing that's really key when you're buying a foreclosure is timing. Because if you're catching something at pre foreclosure, you don't have the most time or unlimited amount of time or 2 3 months like you may have for a normal transaction. So you want to make sure that you're using a product that's time sensitive to what you're trying to achieve. And just like Ty was saying, you need to find a product that also will allow you to buy the house as is. So when we go down this list and we talk about FHA, for example, which is a loan that is for primary residence, meaning you have to buy that home and move into that home. It's not your investment, it's your home that you reside in. Yes, you can buy it with 3.5%, but FHA, it's a federally insured loan, meaning that when you move in there, they want to make sure that it's move-in ready. It has to be in move-in condition. So things like furnaces, holes in your roof, missing pipes, electrical problems, plumbing, those are all going to be reasons why the bank tells you that the house is not eligible. It could be something as simple as siding. All these things go into the picture for the bank to be able to approve that loan. One way to get around it is to get a construction loan or a rehab loan. So you can do a FHA 203K loan, which is a rehab loan, meaning you can buy a house as is, and also use the bank's money to finance the construction costs. Now, there are little nuances with these loans. Like everything has a catch. When you are doing things with a 203K, it does take longer to close. There's a bunch more paperwork, and the more expensive the construction, the more paperwork you have to do. So there's two types of 203K loans. You have a limited and you have a standard. So if it's a standard, which means the construction is more than $35,000, then you're gonna have to find a contractor who's licensed and insured, and have that contractor vetted by the bank to get approved with the bank as a qualified contractor to do the job. Now, when you're doing these kind of loans, do you have 60 days when you catch it at pre-foreclosure? Probably not. But that's what we're here. We're going to talk about how you can shave off some time for these loans in just a second. We also want to touch on conventional loans. Conventional loans, lowest down payment for a single family house is 3%. They typically close a little faster than FHA loans. They also have a little more leniency as far as the condition of the home. But mind you, when you are buying foreclosed homes or pre-foreclosed homes, you want to go in there with the mindset of this house will have problems. If you go in there with that mindset every time, you will not be disappointed because you're prepared instead of reacting. Okay, and of course, the last option is hard money. Hard money can close fast. There are some hard money loans that are basically cash, right? There are some hard money loans where you don't even have to be fully docked, which means providing pay stubs, W-2s, taxes, bank statements. There are different hard money products for different scenarios, but those loans do have a hefty down payment. Most of the times you do have to have higher credit, which means above 680, and other times you have to pay points. So when you're looking at a foreclosed home, you can find a deal, but you have to ask yourself, do your numbers make sense? In both sense of the word, CENTS and sense like common sense. Okay, so does it make sense to do this deal? Do you have the right mortgage product to close on time and also close effectively? Because sometimes you can get an FHA loan and you may not have the reserves or the LTV, loan to value, for 203K loans. So you want to make sure that all these things are going to make sense and that you are going to put your best foot forward by choosing the right product from the very beginning. All right, you can hit the next slide for me, Ty. Okay, cool. So, some ways that you can speed up this process, whether you're buying a foreclosure, a short sale, or even just a normal listed home on the market, is by having all your ducks in a row. Making sure you are on point with your loan officer, and making sure you are on point with your attorney, because these two people, as well as your realtor, are the ones pushing this deal down the field. Okay, so you want to get yourself pre-approved, get fully approved or underwritten approval. We'll talk about that in a second. That's another way to shave off some time. And keeping all your documents together. If you're going to jump into buying a foreclosure, and that's where your mindset is from the very beginning, it really would be best practice for you to either get a Google Drive, a Dropbox, something like that, where you can upload files and share a link so that anyone you give the link to can get to those files. Because a lot of times, what's holding loans up is paperwork and what we call conditions, meaning that there are certain things that we're trying to make the file conform to guidelines. So we need to either have some explanations for things in your paperwork, or you need additional paperwork to support some of the claims that you put on the application in the first place. Okay, so those are two things. Make sure you have all your paperwork in one spot. And also, when you do talk to your loan officer and they do give you conditions, you want to make sure that you are clearing them the same day. The same day is very important, because you can lose these deals just by being too slow on the pull of the trigger. Okay, so I'm going to hit the next slide for me there, Ty. So when you start, you want to know the difference between getting pre-qualified, pre-approved, and underwritten pre-approval. Most people, when you talk to your loan officer and you go through the process, you put in your application, that is a pre-approval process. That means we ran your credit, we looked at your income, we looked at your debt, we looked at the assets, meaning the money that you're going to use to purchase the home. We took into consideration the liabilities on your credit, the bills that you have to pay. We put it all together. We looked at which product that you're using, whether you're using 203K, home style ready, conventional, hard money, whichever product that we think is going to help you get to that home the fastest is the one that we're going to pick, and that's the one we're going to review with you. And you have a choice of which one you want to go with based on the interest rate, the monthly payment. Those are all things that we talk about when we do a pre-approval with a client. So once you get yourself pre-approved and you have your pre-approval, that's the first step. Now, if you are someone that just got pre-qualified, you got a pre-qualification in the mail, you got a pre-qualification through an online site where you just typed in a couple of things on the information, that is just a sheet of paper. It is trash. They did not look at none of your paperwork. They did not pull a credit. They didn't vet you. So you'll be wasting your own time, the realtor's time, the seller's time, everyone's time, because it wasn't properly vetted. So pre-qualified is basically a way of telling you a ballpark number. If you were thinking about buying a home, you kind of think you don't qualify for the amount that you want, go and get pre-qualified. You don't want to hurt your credit. You just want to kind of know, just for your own sake, go and get pre-qualified. That's the best step for you there. But once you're serious and you really want to make that purchase and go into contract, that's when you get your pre-approval. Now, one way that I suggest for you to be able to shave off a lot of the time that's going to actually eat away at this process, is for you to get underwritten pre-approved, which means that an underwriter got the file after you went and got pre-approved, and they went through your conditions, right? They said, okay, you want to use this kind of loan? We're going to look at this file, make sure that it's conforming, that it fits the guidelines of that product, and then they'll go ahead and give you an underwritten pre-approval, which is almost gold. It's almost as good as gold. It's like a final approval. It's not your pre-approved and, before you find out, like, you're actually approved for the loan. That is ironclad. That's what's going to make you have the strongest offer. We're able to do this with a real underwriter, and we're also able to do it with an automated system too, after you've been fully vetted. So you can get yourself underwritten and have an even stronger offer when you go to make those kind of offers to your sellers, and get yourself in the field and shave that time off, which will shrink your closing window and help you catch it when you get into pre-foreclosure. Okay. using creative financing to get some of these deals. So there are ways to do creative financing, which is basically getting financing that's not traditional, meaning you're not going to go and get an FHA, which is a government-backed loan. You may not get a conventional loan, which is a loan for for primary residence. If you work, if you really uh, took the time to learn the finance aspect, that's how you open the door to real estate. And the way you open the door to real estate is by knowing how to basically how to qualify a deal. You need to know a deal when you see one, and people will give you money if you know how to find deals and you know how to make your numbers make sense. So if you go and get a hard money loan and the hard money loan is telling you, okay, I'll give you this loan, but I need you to put down 25%, you can get private lending to give you that 25% as long as you know that your deal makes sense. And these people, especially the private lenders, meaning like it's not a bank, it's probably someone that you know. It could be a relative, it could be another investor who has cash and they just want their cash to work for them. That's one way for you to make sure that you are getting the door open. Is it easier said than done? Of course it is. But once you start learning how to identify a deal, that's when you can go to the county clerk auctions. That's when you can go down to your county's office and get that pre-foreclosure list and start making those calls and doing these things. Like there are tons of websites that would do this for you. I mean, auction.com is also a good resource, but in order for you to start bidding on a property, you need to give them $2,500 down for you to even be able to bid on the property in the first place. And you want to make sure that you know what a good deal is when you see one, and then you know how you're going to make that money back, especially if you're using other people's money in order to get yourself in the real estate industry. One thing that people do when they want to start is they start with a primary residence and they build up that equity, and then when they refinance or cash out or even sell their home, that's when they use those funds to basically go ahead and start investing in other homes, right? So it can take you a while, but it's all about the long term. Like, you know, you can get out here and you can do wholesaling if buying it is not tangible for you. So one thing that we want to make sure you got out of this class is that foreclosures is a great way to get into the market. You may get a deal from it, but you also want to know that your numbers make sense. Like you want to know exactly what you're getting yourself into, and that you have the cash to close, and also, you know, all the resources that you can use in order to get the cash to close. So if you guys had any questions about, you know, non-traditional financing or anything like that, please drop it in the chat. If not, you know, you can reach out to Ty or myself. You know, we'll be going back and reaching out to everyone that signed up through Eventbrite. And we really want to thank you guys for coming and, you know, being a part of this and being here for our first class on this. And we're going to put together other classes where we go in depth, where we touch foreclosures in its entirety, and also go into other types of properties like short sales, subject tos, tax liens, things like that, and show you guys how to, you know, get to buying homes that aren't just listed on the MLS. You know, widen the net, if you will, because prices right now are steadily increasing. Even though buying power has slowed down due to the high interest rates, the prices have not dropped below where they were before COVID. I think that's that's the mark that people are missing. If the prices have jumped up last year 16%, and then this year they're not, you know, steadily increasing, they probably came down 2 or 3%. They're still appreciated, you know, that extra 12%. So, you know, just make sure your numbers make sense, and you know, get all the information you can, because information is definitely going to be the key to you doing this the right way.